The United States monetary system, built on fractional reserve banking and debt generation, is fundamentally incompatible with no-usury or reduced usury frameworks. Usury, defined as the charging of interest or exploitative returns on loans, is the backbone of this system, enabling banks to create money and sustain economic growth. Non-usury, the absence of interest or coercive obligations, exists only in limited, private arrangements and cannot scale to meet the demands of a $21.97 trillion money supply in 2025. The U.S. economy, driven by lending for real estate, consumer goods, and government debt, relies on interest to incentivize credit and manage risk. Historical attempts at non-usury, such as medieval bans or modern experiments, reveal hidden obligations, labor, fees, or social pressures that replicate usury's harm, often with greater opacity. The U.S. system structure, rooted in the Federal Reserve's oversight and a $45.56 trillion federal debt in 2024, ensures usury's permanence, as banks and institutions profit from lending in a debt-driven model. Fractional reserve banking amplifies this by allowing banks to lend beyond reserves, creating money through interest-bearing loans. This process, central to the U.S. economy since the first bank of 1791, fuels a $150 to $200 trillion economic scale but binds borrowers to debt. Efforts to implement non-usury or reduced usury systems, whether through ethical banking or alternative currencies, have failed due to human greed, the need for credit, and institutional profit motives. This essay examines the U.S. monetary system's usurious foundation, defines usury and non-usury, and explores why non-usury is infeasible within this framework. For sections analyze the system's mechanics, the role of usury, historical non-usury failures, and modern barriers to reform, culminating in a conclusion that non-usury is unattainable in the U.S. due to systemic and human factors. Part 1. Mechanics of the U.S. monetary system and usury's role. The U.S. monetary system, formalized with the Federal Reserve's establishment in 1913, operates on fractional reserve banking, where banks hold a fraction of deposits, typically 10%, and lend the rest, creating money through loans. In 2025, the M2 money supply, encompassing currency, checking accounts, and near-liquid assets, stands at $21.97 trillion, driven by lending for mortgages, credit cards, and government bonds. Usury, the practice of charging interest on these loans, is integral, with rates set by the Federal Reserve at 4.75 to 5% in 2025. This interest compensates banks for risk and operational costs, sustaining a $45.56 trillion federal debt in 2024, financed through Treasury bonds. The system's roots trace to the first bank of 1791, which standardized currency and lending, replacing colonial scrip. Banks create money by issuing loans. $1 million in reserves can generate $10 million in loans, expanding the money supply to support economic activity. This debt-driven model relies on usury, as interest ensures banks' profitability and depositors' trust. Non-usury, defined as lending without interest or exploitative returns, is absent in this system, as even private loans often carry implicit expectations. The demand for money to purchase goods, services, or real estate fuels borrowing, and banks, as wealth custodians, charge interest to manage defaults and costs. Without usury, credit would dry up, collapsing economic exchange in a $150 to $200 trillion economy. Historical U.S. experiments, like colonial scrip with low or no interest, required repayment in goods or taxes, introducing burdens akin to usury. The modern system's scale and complexity make non-usury infeasible, as lending without returns cannot sustain banks or meet credit demands, embedding usury as a structural necessity. Usury defined and its centrality to U.S. finance. Usury, historically and in modern contexts, refers to charging interest or exploitative returns on loans, often condemned as predatory in religious and ethical frameworks. In the U.S., usury is the linchpin of the monetary system, where banks charge interest on mortgages, consumer loans, and corporate debt to generate revenue and mitigate risk. In 2025, mortgage rates average 6 to 7%, credit card rates 20 to 25%, and treasury yields 4 to 5%, reflecting usury's role in sustaining a $21.97 trillion money supply. This interest fuels bank profits, with major institutions like J.P. Morgan Chase reporting $50 billion in annual revenue, largely from lending. The U.S. system's debt-driven nature ties usury to economic growth. Government borrowing, at $45.56 trillion in 2024, relies on interest-bearing bonds purchased by banks, institutions, and foreign entities, with interest payments funded by taxes. corporate and consumer debt, totaling $17 trillion and $4.8 trillion respectively in 2024, further embed usury, as borrowers pay for access to capital. Non-usury, lending without interest or coercive obligations, is limited to private, trust-based loans among individuals, where only the principal is repaid. These are rare, small-scale, and unscalable, as banks cannot operate without returns in a system where lending drives money creation. The Federal Reserve's role in setting interest rates and conducting open market operations reinforces usury's centrality. By purchasing bonds, the Fed injects money, but banks expect interest to lend further, ensuring usury's permanence. Without interest, banks would lack incentive to lend, stalling economic activity and undermining the fractional reserve system's ability to expand the money supply. Historical non-usury attempts and their failures. Historical attempts at non-usury or reduced usury systems reveal their infeasibility, even in the U.S. context. Colonial scrip, issued in the 17th to 18th centuries, offered low or no interest loans but required repayment in goods or taxes, imposing burdens akin to usury. These obligations, often enforced by colonial elites, created dependencies, mirroring debt slavery. Other historical systems, such as medieval bans on interest, relied on labor or social pressures, proving more exploitative due to opacity. Similarly, 20th century experiments with alternative currencies, like demurrage-based scrip, demanded tax or labor repayment, undermining non-usury claims. In the U.S., early banking under the First and Second Banks, 1791 to 1836, aimed to stabilize lending but embraced interest to incentivize credit, setting the stage for modern usury. Proposals for non-usury, such as land-backed currencies discussed in historical contexts, failed to scale, as tying money to finite assets like land restricted credit availability. These attempts highlight human nature's greed. Lenders, whether individuals or institutions, demand returns, whether interest, labor, or fees, to offset risks. Even in small-scale systems, social expectations or power imbalances introduced quasi-usurious burdens, as seen in colonial repayment structures. The U.S. economy's reliance on credit for growth, evident in the $150 to $200 trillion economic scale, makes non-usury unattainable. Historical failures underscore that lending, even with reduced interest, requires some form of return to sustain economic exchange, as borrowers need money for goods and services, and lenders exploit this demand, embedding usury in any systemic framework. Part 4. Barriers to non-usury in the modern U.S. system. Implementing non-usury or reduced usury in the U.S. monetary system is impossible due to its fractional reserve structure and debt-driven model. Banks create money by lending beyond reserves, with a $1 million deposit generating up to $10 million in loans, each carrying interest to ensure profitability. In 2025, the Federal Reserve's 4.75 to 5% interest rates guide lending, supporting a $21.97 trillion M2 money supply. This system fuels consumer spending, real estate, and government debt, with $45.56 trillion in federal obligations financed by interest-bearing bonds. Eliminating usury would halt lending, collapsing credit availability and economic activity. Modern initiatives for reduced usury, such as ethical banking or credit unions offering lower rates, still rely on interest or fees to operate. For example, credit unions charge 3 to 5% on loans, less than banks 6 to 7%, but cannot eliminate returns without insolvency. Proposals for alternative currencies, like digital or community-based systems, face similar barriers. Lenders require compensation, and borrowers need credit, reintroducing usury. The U.S. system's global role, with the dollar as an $8 trillion foreign reserve currency, demands stability through interest-driven lending, as seen in bond markets and international trade. Human greed and economic necessity ensure usury's permanence. Banks, holding trillions in deposits, profit from lending to meet demand for housing, business, and consumption. Reversing this model would require dismantling fractional reserve banking, which supports the $150 to $200 trillion economy but risks collapse without interest to incentivize lending. Historical and modern attempts at non-usury fail, as systemic credit demands returns, making no usury or reduced usury unattainable in the U.S. monetary framework. Conclusion: no usury fails in U.S. fractional reserve monetary system. The United States monetary system, rooted in fractional reserve banking and debt generation, is inherently usurious, rendering no usury or reduced usury frameworks impossible. Usury, the charging of interest or exploitative returns, drives the $21.97 trillion M2 money supply in 2025, supporting a $45.56 trillion federal debt and a $150 to $200 trillion economy. Banks create money through interest-bearing loans, with rates of 4.75 to 5% set by the Federal Reserve, ensuring profitability and credit availability. Non-usury, lending without interest or coercive obligations, exists only in private, trust-based loans, which are small-scale, fragile, and unscalable. Historical attempts, like colonial scrip, imposed taxes or goods as repayment, revealing hidden usury worse than explicit interest due to opacity and coercion. Modern initiatives for reduced usury, such as credit unions or ethical banking, retain interest or fees to sustain operations, as banks cannot lend without returns. The fractional reserve system, creating money through lending, amplifies usury's necessity, as seen in mortgage, consumer, and government debt markets. Human greed and the demand for money to access goods and services ensure that lenders, individuals or institutions, impose costs, whether interest or alternative burdens. Proposals for non-usury, like land-backed currencies, fail to scale, as credit demands exceed finite assets, and banks require profits to manage risks. The U.S. system's global dominance, with the dollar as a reserve currency, ties it to interest-driven lending, making reform to a no-usury model infeasible. Historical and modern failures confirm that usury is inseparable from systemic lending, as economic growth relies on credit, and lenders exploit borrowers' needs. The impossibility of non-usury in the U.S. monetary system underscores its reliance on debt and interest, affirming that only private loans escape usury's grasp, while systemic solutions remain unattainable.